Hello, and welcome to this video on AQA A-Level Accounting Section C. This is an example of a written question on variance analysis. So here we go, the example. Kando & Co. work on management projects and operate a standard costing system. The Managing Director is concerned that last month more projects were completed than anticipated, but the actual profit of £36,060 was less than a budgeted profit of £38,000. The accountant has provided the following information for last month. So we've got budgeted amounts and the actual amounts. So for sales, the budget was 80 projects at £1,200 each, whereas the actual amount was 90 projects at £1,150 each. So there were more projects, but at a lower value. Labour, the budget, 10 hours per project at £35 per hour. The actual was 13 hours per project at £32 per hour. So it took longer, but at a lower rate. And the overheads, the budget was £30,000, and the actual was the same amount of £30,000. The accountant has also calculated the variances as follows. So the variance of sales price was £4,500 adverse. The sales volume was £12,000 favourable. The labour rate was £3,510 favourable, and the labour efficiency was £9,450 favourable. Now required, what do we need to do? Assess the significance of the variances on the performance of the business and the Managing Director's views that the variances are caused internally. So two things to do. Assess the significance of the variances, and also the manager's views are that they are caused internally. So we've got to write about all of that. Now the solution plan. So we're going to start with a short introduction on what your assessment is about. And this is basically going to come from the information in the question. So this is an assessment of the significance of the variances on the performance of the business and the Managing Director's views that the variances are caused internally. Now, if I just go back a moment, when we've got like a budget and then an actual amount, and we've got different figures. So sales, we've got 80 projects for our budget and actual for 90. That's basically telling us we need to do a flexed budget. So let's go back to where we were, flexed budget. So prepare a reconciliation between budgeted and actual profits. So here we have the reconciliation between budgeted and actual profits. So here we're going to have a budget column, a flex column, an actual column, and a variance column. So the budget, we were told, were 80 projects at £1,200 each. The flex budget is 90 projects at £1,200 each, and the actual is 90 projects at £1,150 each. So we're going to work out the sales now. So got a little working for the sales. So the original budget, it was 80 projects at £1,200 each, that's £96,000. Now the flex budget is based on 90 projects. So it's going to be the original amount, the original standard amount of £1,200, giving us £108,000. Then the actual budget was 90 projects at the price of £1,150, giving us a total there of £103,500. So we put those into our budget now. We've got budget £96,000 for sales. Flex was £108,000. Now there's a difference of £12,000. That's due to the change in the project amount. So it's gone from 80 to 90. So that's volume there. That's volume of £12,000 favourable, because the amount is greater than the £96,000. Now the actual was £103,500. So the variance is the difference between £108,000 and £103,500. That's £4,500 adverse. Now that matches the £4,500 sales price variance in the question information, which was adverse. Right, labour next now. So another working for labour. Original budget, so it's 80 projects, 10 hours at £35 per hour, £28,000. The flex budget, 90 projects, 10 hours per project at £35 per hour, £31,500. Whereas the actual budget was 90 projects, 13 hours at £32 per hour at £37,440. So we can now enter the labour figures. So the budget was £28,000. The flex budget, £31,500. And the actual was £37,440. So the variance there is the difference between the flex of £31,500 and the actual of £37,440, and that's a £5,940 adverse because the actual amount is greater than the flexed amount. Now that is combination of the labour rate favourable variance of £3,510 in the question and the labour efficiency adverse variance of £9,450. So combined together, they give you a £5,940 adverse variance for labour. Right, now on the contribution, and the contribution is going to be your sales less your labour. So for the budget, it's £68,000. For the flex budget, it's £76,500. And for the actual, it's £66,060. And the variance there is the £4,500 adverse for sales and the £5,940 adverse for labour, giving us a total variance of £10,440 adverse. Now, next we have is the overheads. So we were told the budget was £30,000 and the flex was £30,000 and the actual we were told was also £30,000. So there's no variance there. So the profit now is your contribution take your overheads. So the budget is 68,000 take away 30,000 gives us 38,000. The flexed is the 76,500 take away 30,000, which is 46,500. And the actual is 66,060 take away 30,000, which gives us 36,060. And then the overall variance there is, again, £10,440 adverse. Now those figures now, the budget of 38,000 and the actual of 36,060 now match the figures in the original question. So that's our flex budget there for us. Now we've got to compare the budgeted and actual amounts and explain the variances. So here is a comparison of the flex budgeted amounts and the actual amounts of reasons for the variances, for the differences. So remember, we're comparing the flexed amounts with the actual amounts, not the original budgeted amounts, the flexed amounts. So the sales volume variance is £12,000 favourable. This is due to more projects being completed than budgeted for. I'm going to give some reasons now. This could be because a lower price was charged for each project, £1,150, compared to the budgeted amount of £1,000, which increased the demand for the project. This may have been the reason for lowering the sales price to bring in more sales, or there was strong competition in the market. Discounted prices could have been given to customers, again, to bring in more sales. And the sales price variance of the sales price variance is £4,500 is adverse. Now this leads to an overall sales variance of £7,500 adverse. So this shows that there's an interrelationship between the sales volume and the sales price variances. Now the labour ones now, the labour rate variance is £3,510 favourable. This would be because a lower rate was paid for labour. This could be due to employ a lower skilled labour. Now, this has led to an adverse labour efficiency variance of £9,450, as lower skilled labour would take more time to complete the projects. So overall, this leads to a labour variance of £5,940 adverse. Again, there's an interrelationship here between the labour rate and the labour efficiency variances. Now I'm going to set out our conclusions. So both the labour and the sales variances are adverse, and reasons for these adverse variances need to be investigated. There could be both internal and external reasons for the adverse variances. If the management decided to reduce the labour rate, then the adverse labour rate variance would have been caused internally. If there was a lack of skilled workers resulting in a lower labour rate, then that is an external factor, as a lack of skilled labour could be nationwide. If the management decided to lower the sales price, resulting in an adverse sales price variance, then that could be classified as an internal factor causing the adverse variance for the sales price variance. If there was a fall in UK prices due to competition from abroad, then that is an external factor. Now, it is not possible to decide if the variances are caused internally, as is the managing director's view, without having more details on the reasons behind the fall in the sales price and the reduction in the labour rate.